This video is going to explain the allowance method for accounts receivable. So we've already learned what accounts receivable is. We record accounts receivable as a debit. It's an asset. It's money that we're owed from our customers. Now, the problem with money that we're owed from our customers is we've recorded it as an asset on our balance sheet. Are we going to collect 100% of that money that we're owed? Yeah, hopefully, but probably not. So we have to have a way to estimate the amount that we won't collect, because we need to record that amount in the same period as we recorded the sales revenue. Because if we make a sale and we never collect the money, do we really have a sale? Not really. So we recorded sales revenue and accounts receivable. If we're not going to collect all of that money, we have to record an expense to go with it so that that expense is in the same period as the revenue. That's the matching concept. So what we're going to do is we're going to estimate the amount of the accounts receivable that won't be collectible. And we're going to call that bad debts. So let's say that the company had $300,000 worth of sales, credit sales. At the end of the first year, they had $20,000 of credit sales that remained uncollected. All right, so we're not going to worry about the $280,000 because it was already collected. But right now we have $20,000 in accounts receivable, and we want to estimate how much of that $20,000 won't be collectible. And based on historical data, the company's estimated that $1,500 of that $20,000 won't be collectible. So what we're going to do is we're going to record bad debt expense, which will go on the income statement, which reduces our revenue. And we're going to use a new account called Allowance for Doubtful Accounts. And Allowance for Doubtful Accounts is another contra account. It's a contra asset account, because on our balance sheet, we'll have accounts receivable less allowance for doubtful accounts. That's how we're going to reduce the balance sheet item. We can't take it directly out of accounts receivable because accounts receivable is input by customer, and we don't know which customer we're not going to collect. So we're going to use this contra account to record what we put into bad debt expense. Also, bad debt expense is a temporary account, and allowance for doubtful accounts is a permanent account that resides on the balance sheet because it's a contra asset. So we've recorded bad debt expense and allowance for doubtful accounts. So here's what it looks like. On our balance sheet, we have the $20,000 in accounts receivable, less allowance for doubtful accounts, so we have a net balance of $18,500. Or sometimes it's presented like this, where it just says accounts receivable, net of a $1,500 doubtful accounts. Sometimes instead of being called doubtful accounts, it's called uncollectible accounts. Sometimes instead of bad debt expense, it'll be called uncollectible expense. Whatever it's called, it'll sound like what it is. All right, so let's say that now we figured out that Mr. Kent's $250 account balance won't be collectible. So now it's like, we estimated $1,500 and I figured out what 520 of it's going to be. So we can't record this as an expense. We can't record this as an expense because we already did. We recorded the expense when we estimated it and recorded bad debt expense. We recorded the expense when we estimated it and we recorded bad debt expense. So what we have to do now is we're going to reduce the allowance for doubtful accounts, and we're going to specifically write off the account receivable. We're going to reduce the allowance for doubtful accounts and specifically write off the receivable. So when we're done with this, our allowance for doubtful accounts is less, but our account receivable balance for Mr. Kent is gone. So on our books, Mr. Kent doesn't owe us any more money. Now, the interesting thing about this is that the writing off of a specific bad debt does not affect the net realizable value of accounts receivable. So on the balance sheet, before we wrote off anything, we had accounts receivable of $20,000 less the allowance for doubtful accounts of $1,500, gave us a net accounts receivable balance of $18,500. after the write-off, both accounts receivable and the allowance for doubtful accounts decreased. Since they both decreased by $520, our net is still the same. So when we specifically write off a certain account, our net accounts receivable doesn't change. Okay, so let's say that we've written off this account and then we open the mail and lo and behold, here's a check from Mr. Kent. We were wrong. He did pay his account. So now we want to put it in our pocket and run home, right? No, that would be wrong. You want to put it in the bank. The only problem is you can't put it in the bank because he doesn't have a receivable. You can't reduce his receivable and record cash because he doesn't have one. So the first thing we have to do is reverse that entry that we made before. We're going to put it back in accounts receivable and put it back in our allowance for doubtful accounts. All we're doing is reversing the entry we made when we wrote it off. Now we can record the acceptance the way we always do. This is not new. We'll just debit cash, credit accounts receivable, just like we always have when we collect someone's money. All right, that is the allowance method. The next video, we'll talk about 2 different ways of estimating the allowance.